3. Annuities. Annuities are an investment product purchased in the form of a particular type of contract. Life insurance companies issue all forms of annuities, whereas banks and other financial institutions issue just one type of annuity, known as a term or term certain annuity. Even though annuities are typically associated with regular income type payments, there is another form of annuity that is a savings investment. Annuities that pay an income are called payout annuities. They are differentiated by whether the payout begins immediately, immediate annuities, or at a future date, deferred annuities. Payout annuities are structured on the basis of a deposit of investor capital to an annuity contract with a subsequent repayment of capital plus interest in regular payments to the person named in the contract as the annuitant. The regular payments are considered one of the most important features of annuities. Just as a working person depends on receiving employment income in a known amount on his regular payday, an annuitant depends on receiving an annuity payment on a regular, scheduled date. The annuity payment received by the annuitant is a result of the quoted annuity rate that applies to his capital and the presence of guarantees. All factors affecting annuity payments will be addressed in detail in this chapter. The savings type of annuity is called an accumulation annuity. Accumulation annuities are also known as insurance GICs. They are also structured based on a deposit of investor capital, but the capital plus interest is repaid to the investor as a lump sum. Accumulation annuities provide investment security because 100% of invested capital is returned to the investor. Annuity investing is highly suitable for investors seeking security. 3.1 Advantages of annuities. The advantages of annuities have been briefly addressed in Chapter 1. The following advantages are explained in more detail in this section. Black small square straightforward investment concept, black small square income security that can be adapted to the client's needs and situation, black small square creditor protection, black small square estate planning benefits, black small square annuitant protection, assurees coverage. Segregated funds and annuities. Chapter 3, Annuities 83. 3.1.1 Straightforward investment concept. The fundamental idea underlying both payout annuities and accumulation annuities is quite simple. It looks like this. Capital invested in the annuity equals capital plus interest paid out of the annuity. The payout annuity pays a regular income to its annuitant. It is the most common form of annuity and what most people think of when they think of an annuity. A payout annuity appeals to an individual who wants to receive a regular payment from a lump sum of capital to invest. He wants to invest his capital without risk of loss, and, typically, looks to the annuity payments as a source of regular income, since his investment is repaid to him over time. The investor decides who is going to receive the payment from the contract. This person is called the annuitant. The insurer pays the annuitant on a regular schedule that has been selected by the contract owner. Each payment is comprised of a portion of the invested capital plus interest. The starting point for payments to the annuitant to begin depends on whether the annuity is immediate or deferred. Once started, payments continue for life or the term of the contract. A life annuity ends on death of the annuitant. The term annuity ends on its maturity date. This is the basic concept that underlies all payout annuities. Alas, annuities are rarely as simple as this because they have many nuances available to customize the product to individual needs. An accumulation annuity does not pay an income. It is a form of term savings with a maturity date. At maturity, it may be converted into a payout annuity or surrendered without penalty and its proceeds received by the investor in a lump sum. 3.1.2 Income security. All annuitants enjoy the security of knowing when to expect their annuity payment based on the schedule selected in the annuity contract. Annuities with a level, or set, payment provide income security because the annuitant also knows in advance how much each payment will be. This is guaranteed by the issuer. This knowledge allows the annuitant to plan his finances and spending. This is one reason why many investors choose annuities for retirement income. Level payments are also a way in which the owner can control the amount of income to be paid to an annuitant when the annuitant is unable to manage personal finances on his own. For instance, a parent could establish an annuity for a mentally disabled child with the assurance that the child would receive a regular payment in a known sum. Income security provided by annuities covers different types of income: black small square lifetime income, black small square spousal income, black small square temporary income. 3.1 1.2.1 Lifetime income payments are paid for the lifetime of the annuitant when the annuity is issued as a single life, or straight life, annuity. A joint life annuity also pays an income for life. However, it names two annuitants, who are usually spouses. They may be joint annuitants or co-annuitants. Payments continue for the surviving annuitant after the first annuitant dies. Lifetime income eliminates longevity risk and the worry of outliving one's money. 3.1.2.2 Spousal income. An income for a spouse can be created by a black small square single life annuity in which a spouse is named as annuitant, black small square joint annuity in which both spouses may receive annuity income and at the death of one, the surviving spouse continues to receive the annuity payment. Either form of annuity provides an income or retirement pension equivalent to a spouse. This is helpful for a spouse who has not contributed to a retirement pension or savings plan at work and who, without the benefit of annuity income, would otherwise be without an income or whose income would be very low. 3.1.2.3 Temporary income. A term annuity provides an income to an annuitant for the term of time stated in the contract. The payment period may be as short as a few years or last for decades. A term annuity is useful to bridge income between two dates, such as between the time when an employee takes an early retirement and the time his pension begins. 3.1.3 Creditor protection. The creditor protection available to annuity contract owners and annuitants is of particular interest to those who are self-employed, business owners, and professionals. These individuals are more likely to find themselves in situations in which creditors could make a claim against their assets. Segregated funds and annuities. Chapter 3, Annuities 85. The amount deposited to an annuity contract is protected against financial claims made by creditors of the contract owner when it is a life insurance contract that names specific beneficiaries rather than the contract owner's estate. The intention of the law is to protect the dependents of the insolvent contract owner from creditor claims. Therefore, when a spouse, child, grandchild, or parent is named as beneficiary or beneficiaries of the annuity contract, or an irrevocable beneficiary is named, the value of the contract cannot be claimed by creditors. Some annuities offer unseizable benefits, such as annuities funded by transfer of a locked-in pension, coming from a locked-in retirement account, LIRA. If a contract owner surrenders his term annuity and receives its commuted value, creditor protection would no longer exist for the sum received. Finally, to benefit from creditor protection, the contract must have been purchased well before the owner's insolvency. This ensures the owner has not purchased the annuity to escape his financial obligations to creditors. 3.1.4 Estate planning benefits. Estate planning is the process taken to determine how the assets of an individual will be distributed after death. It can include naming inheritors and beneficiaries, and ascertaining tax liabilities. Annuities offer a valuable estate planning feature through the ability to name a beneficiary to a contract. Payments made to a beneficiary bypass the estate. Therefore, they are not subject to the probate fees charged on the assets of a deceased by provincial/territorial governments, except in Quebec. The beneficiary also receives funds quickly. Annuities also provide protection of estate capital when structured into an insured annuity. This is because the insured annuity uses estate capital to buy a life annuity for its policy owner but replaces the capital with a life insurance death benefit. 3.1.4.1 Insured life annuity. An insured annuity is a strategy that uses combination of two separate insurance products, a permanent life insurance policy and a straight life annuity. This annuity gives an annuitant an income during life and restoration of the amount received by the annuitant to life insurance beneficiaries at death. The insured annuity process begins when a proposed policy owner identifies the sum of money needed on his death to settle his estate, including any bequests for beneficiaries. He acquires permanent life insurance, such as Term 100, T100, or whole life insurance, with a death benefit equal to that sum. After the insurance policy is issued, he buys a life annuity. The annuity is funded with enough capital that its payment will, at a minimum, cover the life insurance premium. On death, the life annuity ends and the life insurance death benefit is paid to beneficiaries and/or the estate. Beneficiaries do not receive the capital of the estate through the will, but they do receive an equivalent amount of capital from the life insurance policy death benefit, tax-free. It is essential for the process to follow the steps in the order described. First, acquire the life insurance policy, then, buy the life annuity. If the proposed policy owner does not qualify for life insurance, the insured annuity strategy cannot be implemented. Example. Stephen, age 60, wants to leave his two nieces a legacy of $250,000 each on his death. If he puts aside the $500,000 now, he no longer has the ability to spend that money. Instead, Stephen purchases a term 100 life insurance policy with a $500,000 death benefit. He names his nieces as beneficiaries of the policy. Premiums for the policy are $1,000 per month. Stephen then acquires a single life annuity using $200,000 of his savings. He receives about $1,000 per month in an annuity payment. He uses the money to pay his life insurance premium. He has effectively bought an inheritance of $500,000 for the sum of $200,000. He still has access to $300,000 of his savings to use for other purposes, such as retirement. 3.1.5 Annuitant Protection, Assurees Coverage. If an insurer that has issued annuities is no longer able to meet its payment commitments, the policies are transferred to another insurer that is willing and able to assume those payments. Assurees facilitates policy transfer and guarantees future payments to specified amounts. An annuitant receives Assurees protection on a payout annuity on the payment in full when it is up to $2,000 per month. For example, if a promised benefit is a level $1,000 per month, the annuitant continues to receive $1,000 per month. When a promised benefit for a payout annuity is more than $2,000 per month, the annuitant receives Assurees protection for the greater of $2,000 per month or 85% of the promised benefit. For example, if a promised benefit is $5,000 per month, the annuitant would receive $4,250, $5,000 times 85%. Assurees protects an accumulation annuity up to 100% of the contract value up to $100,000. Therefore, if an annuity value is less than $100,000, the policy owner receives all of his deposit value. If the annuity value is greater than $100,000, he receives $100,000. 3.2 Types of Annuities. Annuities provide unique opportunities for customization to individual needs and circumstances thanks to the many types, features, and benefits available. Many questions must be addressed in preparing a contract and selecting the type of annuity that will be best suited to the client's needs and expectations. They include, but are not limited to, black small square is the objective of the annuity to pay income or to save. Black small square how many lives will be covered. Black small square will the annuity payments be made for a period of time or life. Black small square when will income begin. Black small square will income be a level payment or variable. Black small square how will the contract be funded. Black small square which form of taxation will apply. Each of these factors is addressed in the sections that follow. 3.2.1 Purpose of the annuity. The two core forms of annuities, previously introduced, are the payout annuity and the accumulation annuity. The purpose of acquiring each is very different, so it is essential the agent understands their fundamental differences to match the correct type with the client's needs. 3.2.1.1 Payout annuity. The purpose of a payout annuity is, as its name suggests, paying an income. The income stream is a blend of interest and principal created from the deposit of capital to the contract and is based on the annuity rate applied at the time the contract is issued. Payout annuities are available as immediate, payments begin immediately, and deferred annuities, payments begin at a future date. Term life is paid to one annuitant for a period of time, straight life is paid to one annuitant for his life, and joint life is paid to one annuitant for his lifetime and then to the other annuitant after the death of the first. 3.2.1.2 Accumulation annuity. An accumulation annuity is a form of term savings with a maturity date. An income stream is not created by an accumulation annuity. Its purpose is investment growth. Accumulation annuities are similar to a guaranteed investment certificate, GIC, but come with the beneficial features of a life insurance contract, such as the ability to name a beneficiary and creditor protection. The accumulation annuity credits interest on deposits on a daily, monthly, or compound basis. Daily interest is not a guaranteed sum. In certain cases, interest may be guaranteed over a number of years, such as 1 year, 5 years, or 10 years, because the annuity deposit is used to buy a fixed-term investment at a guaranteed interest rate. Segregated Funds and Annuities. Chapter 3, Annuities 88. This interest applied to deposits in an accumulation annuity increases the value of the annuity. Once it has matured, the annuity may be surrendered for its accumulated value, or it may be converted into a payout annuity, which will pay a fixed amount based on this accumulated value. 3.2.2 Lives covered. Once the fundamental purpose for the contract is identified, the number of lives to be covered by the contract is established. 3.2.2.1 Single life contract. A contract may be issued to a person naming him or another person as the annuitant. If a person uses funds in his RRSP or RRIF to buy an annuity, he must be named the annuitant. The annuitant receives the income from the contract for a specific period of time or for life, depending on the duration of the annuity. 3.2.2.2 Joint life contract. A joint life contract, also known as a joint and last survivor annuity, pays an income over the lifespan of two people, usually spouses. The two individuals named in the annuity are known as co-annuitants. One individual, or both, receives the payments until one dies. Payments continue to the survivor until his death. 3.2.3 Duration of the annuity. An annuity is issued for a term, a period of time, a lifetime, or the lifetime of two people. 3.2.3.1 Term. An annuity issued to pay income to a specified age, such as to age 71, or for a specific length of time, such as 10 years, is a term annuity. All other factors being equal, the longer the term, the less received in each annuity payment. Example: Donald, age 65, deposits $100,000 to a 5-year term annuity. He receives approximately $1,700 per month in his annuity payment. If the annuity was a 10-year term, he would receive about $900 per month. 13. When a term annuity ends, all payments cease because the annuitant has received the entire principal deposited to the contract with the interest earned on that principal. If death of the annuitant occurs during the term, the balance of annuity payments is paid to a beneficiary. A term annuity policy owner may have the choice in his contract between 3 different methods of paying out the value of the contract if the annuitant dies during the term. Each method has its own pricing structure. Black small square 1 method puts the monthly payments into the hands of the beneficiary for the period remaining in the term. In effect, the value is paid in installments to the beneficiary and is sometimes called the installment refund choice. Black small square another method sees the beneficiary receive a lump sum payment that represents the present value of all future payments paid as a cash refund. This is also known as the commuted value of the annuity or the cash refund choice. Black small square the final method pays the beneficiary what remains of the original deposit. For example, if the contract was funded with $100,000 and $75,000 had been paid out, the beneficiary would receive $25,000, $100,000 to $75,000. This is known as a capital protection guarantee. A term annuity to age 90, T90, is one option available to those whose registered retirement savings plan, RRSP, is maturing, and the RRSP account must be closed. Using some or all of the value in the RRSP to buy a term annuity continues tax deferral on the money. A term annuity to age 18, T18, is available for financially dependent children younger than 18 who receive the proceeds from the RRSP/RRIF of a deceased parent or grandparent. The lump sum in the registered account is transferred to the child's annuity tax-free. The child can receive payments from the annuity until the day before he turns 19. Tax on the payments as they are received is paid by the child at his marginal tax rate. 3.2.3.2 A single life or 2 lives. An annuity may be structured to pay an income over the lifetime of one person or two. As stated earlier, when a single life is the basis for the contract, the annuity is called a single or straight life contract. When 2 lives are covered in an annuity, the annuity is a joint and last survivor annuity. Payments may be issued to both annuitants or to one annuitant. When the first annuitant dies, payments continue or transfer to the co-annuitant, usually the surviving spouse. The contract may be structured to pay the co-annuitant 100% of what had been received by the deceased annuitant or a reduced percentage of the full payment. The reduced amount paid is usually 50%, 60%, or 75% of the full payment. An impaired annuity is a form of life annuity. It is issued when the annuitant has a shortened life expectancy due to poor health because of a serious disease or deteriorating condition. This is true for both a single life annuitant and joint life annuitants when both spouses suffer from medical conditions. Impaired life annuities are also called enhanced, age-rated, or accelerated annuities. The amount of payment received by the annuitant is based on underwriting of his medical condition. The annuitant must provide a medical certificate proving substandard health. Once impairment is proven, the annuitant pays less as a premium or receives a higher payment than someone of the same age and gender who does not have a health condition. This is because payments are issued over a shorter period of time corresponding to the shortened lifespan. 3.3 Funding an annuity. A policy owner has a choice of how to fund, or pay for, an annuity. A payment may be made in a lump sum or transfer of a lump sum, or payments may be made over a period of time as deposits. An immediate annuity must be funded with a lump sum. It is necessary that the entire sum of capital is immediately on deposit with the insurer so payments can begin within the first year of the contract. A deferred annuity could be funded with a lump sum or a series of deposits. 3.3.1 Lump sum deposit. A lump sum deposit is made when funds are transferred from a registered or non-registered account to the annuity. The deposit occurs once by transfer from non-registered investor savings and investments or from a registered account. Segregated Funds and Annuities Chapter 3, Annuities 91. Agents must be alert to indicators that a lump sum deposit is an effort by the purchaser to launder money or finance terrorist activity. They should read and bear in mind the guidance from FINTRAC, Financial Transactions and Reports Analysis Center of Canada, specific to life insurance and annuity providers. It can be found online. Point 14. The agent must follow FINTRAC client identification requirements when an individual purchases an immediate or deferred annuity or segregated fund that costs $10,000 or more over the duration of the policy, and when the insurer is to remit $10,000 or more to a beneficiary over the duration of the annuity or policy. If an agent receives $10,000 or more in cash in a single transaction or multiple cash transactions of less than $10,000 each that total $10,000 or more within a 24-hour period, he must submit a large cash transaction report to FINTRAC. 3.3.1.1 Transfer from a registered account. A typical circumstance in which a transfer of funds forms a lump sum deposit to the annuity is when an RRSP is maturing, and the account owner chooses an annuity as a maturity option. Such a transfer is exempt from FINTRAC requirements. Transferring funds from an RRSP or RRIF continues the tax deferral on the amount that is transferred to a registered annuity contract. Therefore, there is no immediate tax consequence for a transfer. The policy owner and annuitant must be the same person when registered savings are the source of funding. He can choose a life or T90 annuity. Locked-in pension savings accumulated in an employer-provided or group pension plan can be transferred only to a life annuity. This includes funds in a locked-in retirement account, LIRA, Life Income Fund, LIF, or a prescribed retirement income fund, PRIF. When a spouse transfers locked-in savings from a registered pension plan, LIRA, or LIF to fund an annuity, he must acquire a joint and last survivor life annuity. This ensures that if the pensioner dies before his spouse, the surviving spouse will continue to receive an income. That spouse can waive the right to the annuity in writing. 3.3.2 Regular deposits. Regular deposits, or premiums, can also fund an annuity. Annuity payments cannot begin on any type of annuity until after the last deposit has been made. 3.4 Annuity income. The contract owner of a payout annuity must choose on the application when the annuity income payments begin and whether they will be a level amount or variable amount. The annuity income may begin immediately or at a selected future date when it is deferred. 3.4.1 Immediate income. A policy owner who selects immediate income for the annuitant deposits a lump sum to fund the annuity. This creates an immediate annuity. The annuitant receives his first payment at the next payment date after the contract is finalized based on the payment schedule he selected. This may be the next month, 3 months, half year, or year. 3.4.2 Deferred income. A policy owner who selects income to be paid at a future date has a deferred annuity. There are 2 phases to the deferred annuity: accumulation and income. During the accumulation phase, the annuitant either deposits a lump sum to the contract or pays regular premiums. Deposits held by the insurer in reserve for future annuity payments earn investment income. The income phase begins at the end of the deferral period, for instance, 10 years after the first deposit. A maximum length of time permitted for the deferral will be stated in the contract. 3.4.3 Level income. A level payment is a payment that is the same for the duration of the annuity. The annuitant knows exactly the sum to expect in each payment. 3.4.4 Indexed income. Indexed income is income that increases over its payment period. Indexing an annuity increases payments annually by a percentage selected by the policy owner. Therefore, income increases year over year to keep pace with rising costs. The maximum amount of yearly increase is capped, for instance at 4%. The purpose of increasing income is to keep it in step with inflation and address inflation risk. If a person's cost of living increases due to inflation but his income does not, he has two choices. He can spend the income he receives and buy less. If he does this, he will have a reduced standard of living. His other choice is to maintain his standard of living. This will require more money coming in. If he makes this choice, he runs the risk of depleting his financial resources earlier than planned. If investors deposit an equal amount to the contract, payments in the early years of the contract for the indexed annuity will be lower than an identical, non-indexed annuity. This is because the investor's capital must fund the future, higher payments. If the lower payments to begin are unsuitable for the investor, he will need to increase his deposit to the contract. Example: Gaston and Maurice each buy an annuity with $250,000 in capital. Gaston buys an indexed annuity to keep his annuity income in step with inflation in the future. Maurice does not buy the indexed option. Gaston is going to receive higher payments in the future. In order to fund these rising payments, the annuity issuer compensates by paying Gaston less now, compared to Maurice. In the future, Gaston's payments will grow. Maurice's payments over the duration of the annuity will be the same as the first payment. Gaston's income will keep pace with rising costs, Maurice's will not. 3.4.5 Variable income. A variable income annuity is an immediate life annuity with the ability for the annuitant to earn market-linked returns. A market-linked return is a return linked to performance of a market index, such as the S&P/TSX Composite Index. The annuitant who has a variable income annuity is paid on the basis of annuity units. He receives a set number of units at the time his deposit is made. The contract owner chooses the investment mix on which unit value is based. He also selects a rate of return that must be attained before his income payments will increase. If the value of the units increases above the chosen rate of return, the annuitant's income increases. If the value of the units declines, the annuitant's income falls. The variable income annuity mitigates interest risk and inflation risk since returns are intended to increase with the market. However, since the contract owner will face equity risk, he must have the required level of risk tolerance that matches equity investing. 3.5 Factors affecting annuity payments. Annuity quotes and payments are individualized for each annuitant. Rates offered to annuitants vary by insurer. Policy owners will often comparison shop in order to find the best payment rate. 3.5.1 Annuity rate. The annuity rate is a dollar figure quoted to future policy owners based on the current interest rate and other factors that pertain to the annuitant and how the annuity contract is structured. In effect, it represents the return on the sum invested in the annuity. Example: Bernadette purchases an annuity contract with an annuity rate of $6,000 per $100,000. If she deposits $300,000 in the annuity, she will receive payments of $18,000, $300,000 divided by $100,000, times $6,000, annually. The annuity rate also takes into consideration costs that are applied against the contract, such as commission and insurer expenses. Rates differ between issuers since they do not all use precisely the same interest rate or calculation of the following cost factors. 3.5.1.1 Interest rate. The interest rate in effect at the time the contract is issued is a major factor in determining the payment to the annuitant. The interest rate assigned to the annuity never changes over its duration. It is based on the prevailing interest rate offered in other forms of interest-bearing investments at the time the contract is issued. The annuitant does not benefit from a higher payment if interest rates rise over the duration of the contract. This is the reason annuities have interest rate risk. 3.5.1.2 Age of annuitant. The age of the annuitant when payments begin is a significant contributor to the amount received as income from life annuities. The older the annuitant, the more paid since lifespan is a shorter period of time. People are also living longer. This is reflected in mortality tables used by insurers to predict lifespan when issuing a life annuity. The companies want to ensure payments made to the annuitant or annuitants are adequately funded by the policy owner's deposit. If the insurer miscalculates or an annuitant lives longer than anticipated, payments are made from the insurer's financial reserves. 3.5.1.3 Gender of annuitant. Women receive a lower life annuity payment when all other factors are the same because, on average, they live longer than men. When the same amount is paid out over a longer period of time, each payment will be less than if the money was paid out over a shorter period. 3.5.1.4 Deposit amount. A progressively more attractive annuity rate is generally offered as the amount of deposit available to fund the contract increases. Insurers want to attract large accounts. To do so, they may offer a higher rate of annuity payment to those who have more to invest. 3.5.1.5 Payment schedule. Slightly more is received when the length of time between payments is longer rather than shorter. This is because the insurer has the unpaid sums at its disposal to invest. Since the insurer earns more, it rewards those who wait a longer time for payments by paying them slightly more. Therefore, a single annuity payment received at the end of each year is greater than the total amount received through 12 monthly payments. 3.5.1.6 Length of payment period. When the policy owner buys the annuity contract, he commits to deposit a set amount of principal to the insurer. The insurer doles out that principal plus interest over the period of time represented by the type of annuity chosen, term or life. The longer the payment period is, the lower the amount of each payment. Therefore, the length of the payment period is a significant factor in determining the annuity payment. When the length of the payment period is backed up by a guarantee, the guarantee is a potential expense to the insurer. The insurer factors its cost into annuity payments and decreases payments to pay the potential guarantee. 3.5.2 Guarantees. Guarantees customize a life annuity contract to suit the needs of the policy owner. They increase the cost of the annuity for the policy owner and consequently decrease the amount the annuitant receives. However, guarantees reduce the risk that the initial deposit will not be paid out in part or fully, and therefore, protects the invested capital. Term annuities do not require guarantees since, one way or another, the principal is paid out. In a joint and last survivor and life annuity, a guarantee is an option chosen by the policy owner. 3.5.2.1 Guarantee period and guaranteed capital. Annuities are funded with large sums of personal capital. A common minimum investment is $50,000. Therefore, ensuring the capital is returned to the investor or his beneficiary is very important to the investor. This is the basis for guarantees on annuities. A term annuity is guaranteed for its entire term. The annuitant receives the annuity benefit, and if he dies during the term, a beneficiary receives the difference between the sum invested and the amount paid to the annuitant. The three options available for a beneficiary are discussed with the term annuity topic. A life annuity can be issued with or without a guarantee. 15 The guarantee is for a specified number of years, such as 5, 10, or 20 years. This length of time referred to as the guarantee period. The annuitant receives the annuity benefit until his death. If he dies before the end of the guarantee period, his beneficiary receives a payment from the contract. The amount the beneficiary receives is the difference between the number of payments provided by the guarantee period and the number of payments the annuitant received. If the annuitant dies after the guarantee period, the beneficiary does not receive a payment. The amount the beneficiary receives may be paid in a lump sum, corresponding to the current value of future guaranteed payments, or over time, in installments. When the lump sum option is selected, the annuity is said to be commuted. Installment payments are paid to the beneficiary for the remainder of the guaranteed period. This guarantee brings peace of mind to the policy owner because he knows that a sum of money from the annuity is guaranteed to be paid out, first to the annuitant himself and, if he dies, to the beneficiary. The guarantee period option does not apply to the total amount invested in the contract, rather it safeguards some of the investment. The type of guarantee that protects the total initial investment is called a capital protection guarantee. Available in life annuities, the capital protection guarantee returns a sum to the beneficiary equal to the difference between payments received before the death of the annuitant and the initial capital. The annuity is called a cash refund annuity if the beneficiary receives a lump sum. If the amount is paid in installments, the annuity is called an installment refund annuity. A life annuity without a guarantee is a risky investment. The annuitant of a single life contract could die after receiving his first monthly payment. If Northwest guarantee was in place, no payment would be made to a beneficiary. The balance of the sum invested with the insurer would then belong to the insurer. However, a life annuity without a guarantee also pays at a higher rate than when guarantees are added. The contract owner or annuitants must weigh the return against the risk to decide which form of annuity is most suitable. 3.5.2.2 Guaranteed Survivor Income. Survivor income is guaranteed for 2 lifetimes by choice of a joint and last survivor annuity. However, a guarantee period can be added to the contract to again provide the assurance that a certain amount will be paid out from of the amount invested. Because annuity payments to a surviving annuitant extend the payment period, joint annuities generate lower payments than a single life annuity, all other factors being equal. As an alternative to a joint and last survivor annuity, a spouse who is named as a beneficiary in a single life annuity contract with a guaranteed payment could receive income in the form of installment payments. 3.5.2.3 Return of Premium Guarantee. Some insurers offer a return of premium guarantee as a rider to the contract. This ensures the full deposit to the contract is paid to the beneficiary if the annuitant dies before the first payment. 3.6 Limitations of annuities. Like all investments, annuities have disadvantages that must be weighed by the proposed policy owner against their advantages to determine if an annuity is an appropriate investment choice. 3.6.1 Risks. Annuities are insulated from many typical investment risks for the contract owner and annuitant when they are not issued in the variable income form. Once the contract is finalized, including naming of a beneficiary, if applicable, the investor knows how much to expect, due to the promised annuity rate, and when, due to the timing and schedule selected in the application. No further decisions are required. The annuity is set with its Canadian issuer and for the most part, unchangeable. The lack of flexibility hampers flexibility to acquire funds for unforeseen expenses. 2 other risks associated with annuities are interest rate risk and inflation risk. 3.6.1.1 Interest rate risk. Interest rate risk is often associated with annuities, especially when interest rates are low at the time the contract is drawn up. Contract owners rightfully worry that they may enter into a contract when interest rates are low only to see rates rise thereafter. A higher interest rate would pay a higher income. However, if a term annuity is issued when interest rates are high, its owner could find a reduced benefit if he renews his annuity when interest rates have fallen. Interest rate risk can be managed during a period of low interest rates by using investment capital to buy a series of annuities instead of buying a single annuity. By spreading investment capital into 2 or 3 annuities, acquired over a number of years, the policy owner may be able to benefit if interest rates rise. 3.6.1.2 Inflation risk. Inflation risk goes hand in hand with interest rate risk. If the cost of living and interest rates climb, and the annuity is a life annuity or a lengthy term annuity, the annuitant will feel the effect of inflation. His annuity payment will have less buying power than if it kept pace with inflation. This risk can be managed by acquiring an indexed annuity. Less is initially received in the annuity payment because the principal must be available to increase payments in the future. 3.6.2 Loss of capital. A life annuity contract without a guarantee period risks loss of capital. A policy owner who buys a single life annuity without a guarantee period runs the risk that the annuitant could die at any time and the balance of the capital would not be paid out. This risk is managed by adding a joint annuitant to the contract, and/or adding a guarantee period to the contract. Black small square. A surviving joint annuitant continues to receive payments after the death of the first joint annuitant, providing both annuitants do not die at the same time. Black small square. The guarantee period ensures a certain sum is paid from the contract, although payments to the annuitant are less when a guarantee period exists. Black small square. A beneficiary is named to receive a sum from the contract if the annuitant dies before the end of the guarantee period. Segregated funds and annuities. Chapter 3, Annuities 100. 3.6.3.1 Withdrawals. Payout annuities do not permit withdrawals. A withdrawal may be made from an accumulation annuity. When this occurs, a market value adjustment, MVA, may be charged. The MVA is a penalty calculated by the insurer that has issued the contract. The agent must inform the contract owner that a withdrawal may be reduced by the MVA. The MVA is based on time, interest rates, and expenses. Black small square. The time is the difference between when the withdrawal is made and the maturity date of the investment. Black small square. The interest rate factor looks at the guaranteed interest rate and the interest rate in effect at the time of withdrawal. Black small square. Expenses are the costs incurred by the insurer. Withdrawals affect the amount available to fund annuity payments in the event of conversion of an accumulation annuity to a payout annuity upon maturity. 3.6.3.2 Surrender. When a policy is surrendered, it is terminated. Any annuity funded by the transfer of locked-in funds from a registered pension plan, a locked-in retirement account, LIRA, or a life income fund, LIF, cannot be surrendered. A term annuity may be surrendered for its commuted value. This means the annuity can be cancelled and the future annuity payments taken in a lump sum. Surrender of a life annuity may be possible when annuity payments have not started. A portion of the investment capital deposited to the contract is returned to the policy owner. A contract cannot be surrendered after payments from a life annuity start. An accumulation annuity may be surrendered at any time and its cash value is received by the policy owner. In every case, the terms for surrender are described in the annuity contract. Penalties may apply and reduce the amount received by the policy owner. 3.7 Taxation of annuities. All annuity payments are a blend of investment capital deposited to the contract by the policy owner and interest earned on that capital. Payout annuities are taxed depending on the type of income used to fund them and whether they qualify as being prescribed. Accumulation annuities are subject to accrual taxation annually during the accumulation phase unless they are held in a registered account. The accumulated value is only received through withdrawal or surrender, or by conversion at maturity to a life annuity, which then issues payments. 3.7.1 Taxation of registered payments. When an annuity is purchased with taxable registered funds, such as by transfer from a registered retirement savings plan, RRSP, the entire payment received by the annuitant is taxed as income in the year it is received. A deferred annuity purchased with registered funds is not taxed during the deferral period. Remember that with registered funds, the investor and the annuitant are one and the same. Withholding tax is applied to payments when annuities have been purchased with funds transferred from a registered pension plan, LIF, LIRA, or Deferred Profit Sharing Plan, DPSP. Withdrawals from a registered accumulation annuity are charged a withholding tax, except if the account is a registered retirement income fund, RRIF. Then, withholding tax only applies on amounts withdrawn above the annual minimum allowed amount. 3.7.2 Taxation of non-registered payments. A withdrawal from a non-registered accumulated annuity must be reported for tax purposes. The interest portion of payments made from a payout annuity purchased with non-registered funds may be taxed as prescribed or accrual, also called non-prescribed, income. Accrual income is taxed annually in the hands of the annuitant. When an annuity is deferred later than December 31st of the year following the purchase date, it is taxed on an accrual basis. When income begins, the tax treatment switches to being prescribed only if the annuity qualifies. Whether an annuity is prescribed or taxed on an accrual basis, the amount of income tax paid over the full payment period is the same. The timing of the tax is the difference. 3.7.2.1 Prescribed annuity. A prescribed annuity pays the same amount of interest and investment capital to the annuitant in every payment. Payments are thus said to be level. This is highly desired because the amount of interest to be declared for income tax does not change and tax obligations can be known and planned for. In the early years of the contract, less tax may be paid than would be paid for an accrual annuity. There are a number of requirements that must be satisfied for annuity income to be prescribed. They include Black small square annuity cannot be indexed. Black small square annuitant and policy owner must be the same person unless the annuity is joint life, with a spouse or sibling named as co-annuitant. Black small square payments must begin no later than December 31st of the year following the purchase date. Diagram 3.1 Taxation of prescribed and accrued annuity income. Income. Income tax on an accrual annuity is payable on interest earned in the year of purchase from the purchase date to the policy anniversary. Thereafter, income tax is payable on the interest received for the full year and reported on the income tax return for that year. 3.7.3 Tax on guarantees. The tax on guarantees paid to a beneficiary is not clear and guidance should be sought from the insurer issuing the guarantee payment. 3.7.4 Tax on surrender. When a policy is surrendered, tax applies on investment growth in the contract unless registered funds are the source of contract deposit. In that case, 100% of the amount received from the surrender is taxed at the same rate as interest in the year it is received. The agent should always seek the advice of the tax specialist of the insurer that holds the contract to be able to properly prepare his client for tax withholding and tax payable. 3.7.5 Tax benefits. Annuity income may be eligible for the tax benefits of income splitting and the pension income tax credit. Income splitting allows 50% of the taxable income from a payout annuity contract with an insurer to be transferred to a spouse. Tax savings result because the annuitant reduces his income by the amount of transfer when the spouse pays tax at a lower marginal tax rate. Attribution rules may limit income splitting possibilities. The pension income tax credit is a federal tax credit that is allocated if the taxpayer has eligible pension income such as the income paid by an annuity. The maximum credit is $2,000 annually. The tax credit is available to annuitants age 65 and older. Those younger than 65 can take advantage of the tax credit if they receive payments from an annuity in a registered account that was owned by a deceased spouse or common law partner. Was owned by a deceased spouse or common law partner. 3.8 Annuity classification. Annuities are classified according to their features and potential limitations. Diagram 3.2 illustrates what characteristics define the various types of payout annuities frequently encountered in sales. Diagram 3.2. Structure of payout annuities. 3.9 New types of annuities. Two new types of annuities were introduced in 2019, though the legislation is not yet enacted to make them available to investors: the Advanced Life Deferred Annuity, ALDA, and the Variable Payment Life Annuity, VPLA. Both are, as their names suggest, a form of life annuity, but they differ from the life annuities already discussed. Their primary objective is unlike that of other annuities in that they are intended to provide Canadians with greater flexibility in managing their retirement savings. These annuities will be new to the Canadian market. It remains to be seen if they will interest consumers. New agents should be familiar with these names and their main features. 3.9.1 Advanced Life Deferred Annuity, ALDA. An Advanced Life Deferred Annuity, ALDA, is a life annuity available to individuals who have an RRSP or a RRIF or who participate in a Deferred Profit Sharing Plan, DPSP, a Pooled Registered Pension Plan, PRPP, or a Defined Contribution Pension Plan, DCPP. More on these accounts and plans is provided later in this manual. Key to this form of annuity is the ability to defer payments until the end of the year in which the annuitant reaches 85. Therefore, the ALDA addresses longevity risk and ensures that investors do not deplete their savings prematurely during retirement. Also important to note is that the funds deposited to an ALDA are no longer controlled by the account owner. This lessens the need for decisions about investments at a time of life when people may lose their ability to make complex financial choices. Payments are periodic, as with other annuities. The ALDA cannot be commuted or surrendered, or provide a guarantee. Thus, there is significant risk of loss of capital. A lifetime limit of 25% of the value of the qualifying plan, to a total of $150,000, applies to ALDA purchases and will be indexed to inflation. Income received will not be included in calculating the minimum annual amount withdrawal from a RRIF, a PRPP account or a defined contribution account, after the year in which the ALDA is purchased. 3.9.2 Variable Payment Life Annuity, VPLA. A variable payment life annuity is an option for a PRPP contributor or members of a DCPP. Transfers to fund the VPLA are made directly from each type of plan if the plan administrator has established a VPLA arrangement. A minimum of 10 retired members is required to implement the annuity. The VPLA requires that periodic payments begin by the end of the year in which the member turns 71 or the end of the calendar year in which the VPLA is acquired. There are no guarantees. This form of annuity may be subject to provincial pension benefits standards legislation. Chapter 4 Investor Profile. Competency components. Black small square analyze the client's needs and situation. Black small square implement a recommendation adapted to the client's needs and situation. Competency subcomponents. Black small square determine the client's situation, investment objectives, and investor profile. Black small square assess the appropriateness of the client's existing coverage in regard to his or her situation. Black small square articulate the client's needs based on the risks that could affect his or her financial situation. Black small square propose a recommendation adapted to the client's needs and situation. Segregated Funds and Annuities. Chapter 4, Investor Profile. 108.